Hi, everyone, and thanks for joining us today on the Represented series. Really excited about our guest today, who's going to be talking to us about 5 tax strategies for small business owners. Our guest, Al-Nesha, is the founder of ASE Group, a licensed CPA and QuickBooks Online certified pro advisor. She has over 14 years of experience in accounting and auditing. Al-Nesha is active in community affairs, a mentor at her alma mater, Montclair State University, an instructor at a local college, and a board member on a nonprofit organization that benefits families in urban communities. She graduated from high school in Newark, New Jersey, earned her bachelor's degree in business administration with a double concentration in accounting and marketing, and her MBA with a concentration in management. So without further ado, I'll bring in Al-Nesha.
Hi.
Welcome, Al-Nesha. Thanks for joining us.
No problem. I'm so happy to be here.
I'm so happy to have you here. And of course, thanks for joining the CHIP community as well as one of our amazing CPAs. So we're happy to also have you within our network. So before we get started and get into the great education that you'll teach us about today around tax strategies, I really want to know, what has your journey been like as a financial professional of color, and what does that really mean to you, especially, with everything that's going on today?
Well, that's a whole, we
I
can talk
know
about
it's like
that
a whole
all
nother
day, right?
series.
We know right now. But in general, it's so important to me because prior to becoming a Black female CPA, I didn't know any Black female CPAs. Of course, they exist, but when you hear CPA, you think older white male. And clients are usually surprised to see that I'm young and I'm Black. And for me, it was important to be in a position where I could help other people in my community, where I was visible to people in my community, where I speak the language of those that are in my community. I understand what it's like to start a business and not have a lineage of business owners in a family, and not have people you can really tap into and ask questions about running a business. So for that reason, it was important that I made myself available to those that I've grown up with, that I lived next to, my neighbors, and just to bring a different face to accounting and be a source of mentorship for other African American and minority accountants.
Yeah, absolutely. It makes such a big difference, visibility and just ease of access. I mean, some people don't even know that we live literally in their backyards and we're really entering a part of their community. So kudos to you and all that you're doing in your community. So again, without further ado, I'll kind of pop off and I'll let you take it away. And thank you again.
Thank you. All right, let's get this here. Okay. Can you see my screen?
Yep, you're good to go.
Perfect. Okay. So as Dana mentioned, my name is Al-Nesha. Today we'll be talking about some tax saving strategies for small business owners. I could literally talk about this all day and probably put you to sleep over the night if we talked about all the strategies, but these are the most missed strategies that I find with new business owners. So a little bit about myself and ASE Group. We're a fairly new firm. We're based in New Jersey, and we primarily serve small business owners. And those small business owners either live or work in New Jersey, New York, Connecticut, and Pennsylvania. As a CPA, I am able to assist in all 50 states, but I find it most efficient to help business owners that are in the neighboring states in which I live, because I have zero interest in learning all 50 states' tax laws every single year as they change. We do have some clients that are further than this area, but they really are the minority. Outside of assisting small business owners, we specialize in overall accounting, bookkeeping, tax planning, and tax prep for individuals who live and work in different states, landlords or residential property owners, those with capital gains and losses, and nonprofit organizations. And as I mentioned, this was really founded to be a resource to those in my community, but I also wanted to gain freedom over my time. And I didn't want to ask for a day off, especially with my family structure. So a little bit about me: I have 3 children, 2 homes or 2 properties, just 1 husband, 1 dog, a gang of fish. So I live a busy life. I've been a CPA since 2009, and I have over 10 years of experience in corporate America. I resigned from Prudential, the life insurance company, in 2016 to start my firm. And my everyday motive, just so you understand where I come from and where my thoughts and strategies come from, my goal is always just to spend less so I can work less and have more time with those 3 kids that I mentioned. So I figured the best place to start would be to first acknowledge the most common errors, because this is a great segue into the tax savings strategies. So I love working with new business owners. I love all things entrepreneurship. I love to see people take a risk and start a new business and build on their ideas. But I also understand what comes with jumping out with an idea and not understanding all the business mechanics behind what makes a sustainable business run. So the most common errors I see, number one, is believing you only have to worry about taxes on the tax filing deadline. In reality, the thought about taxes and managing your finances is a year-round thought. It's a year-round conversation, and it is really the only way to manage it, to not wait until that January to April timeframe to think about it. If you wait that long, then your CPA or accountant, you've really minimized the amount of impact they can make for you. It's similar to failing an exam and there are no do-overs, and you come to the professor and say, oh, I want to, what could I have done to do better? And they're like, I can help you prepare for next year's or next test. But there's very few we can do. There's very few things we can do about what just passed. Ideally, business owners should be reviewing their financial statements with an accountant or a CPA at least 2 to 3 times a year. So if you really want to benefit from tax planning, you want to really optimize your structure, minimize your liability, and you want to make accurate estimated tax payments at minimum 2 to 3 times a year is the number you should be seeing an accountant. Second most common new business error, and I love Google, but relying on Google and good luck to replace professional expertise. There are just some things that have to be business expenses for you, and avoiding them can actually be more expensive. And everything that I'm discussing with you today these are things that I've seen with clients in my own experience, not just things I'm telling you from other people's experience. So, not investing in a meeting with an accountant to really understand what your obligations are as a new business owner could be costly on the back end. I had a client who I'm helping them get out of a mess. They had a really successful business, and they didn't know they had to collect sales tax. And then the state of New Jersey cracked down and assessed them a sales tax balance that was so large that they had to shut down their business because they didn't have the funds to pay for it. So that could have been avoided by having a conversation with an accountant and really understanding all of your responsibilities. So meeting with an attorney if you form a partnership to get a really strong partnership agreement instead of just downloading one from LegalZoom. Try not to download anything from LegalZoom. But not getting one that's custom to your business could really be costly. In the end, and I'm not telling you to take thousands of dollars out of your budget and spend it on all sorts of professionals, but in the absence of funds, get some free consultations on your schedule. They're your friend and can get you more guidance than you may get just on Google, which may not be specific to your business type, your industry, or you. And then the third most common new business owner tax error is not selecting the most appropriate entity structure for your business. And that will change, right? So you won't always have the same entity structure from the beginning and as the business evolves. So a couple of things to note there. LLCs are a state recognized entity, and I'm referring to a single member LLC. The IRS really doesn't acknowledge, so to speak, a single member LLC. It's considered a disregarded entity for tax purposes if you don't elect some other form of taxation. So your tax return as a single member LLC is exactly the same as a sole proprietor. I still support LLCs. I love LLCs. It's just the IRS says LLC is no different from you, the individual. Another thing people don't know is that a 2-member LLC forms a partnership for tax purposes. So it's not just forming an LLP that forms a partnership. If you put more than one member on the LLC for tax purposes, you now have a partnership that has partnership tax filing requirements. That tax return is not doing the same day as your individual tax return. It carries hefty penalties. So there's just a lot that could go wrong there if you don't understand that. And in a non-community property state like New Jersey, a married couple that forms a partnership is still considered a partnership. So even though you might file together with your spouse individually, you have still created a partnership filing requirement. This one's a huge one, and this is like thanks to Google, but most new business owners should not start as an S Corp entity. I see it a lot, and people say, I read online that this was going to save money, so I elected the S Corp election, and it's a mistake unless you can justify electing it. So you don't automatically save money as an S Corp. You have to have a lot of things in place that an S Corp requires, and your savings need to outweigh the cost of running an S Corp. And we'll talk a little bit more about that, but don't start as an S Corp unless you have valid reasoning and the income to support it. And don't automatically start as a C Corp. Not everybody needs to be a C Corp. Most people don't actually need to be a C Corp because it requires so much advanced oversight. You also have the taxation both at the corporate and the individual level. So take some time to evaluate what the best structure is now, and then moving forward, if you have an accountant, they can help to assist with determining what works best on a go-forward basis. So then which on this picture is worth more, right? So here you have a $100 bill, and then you have five $20 bills. This is not a trick question. And hopefully your answer is that they're equal. This is so important to recognize because whether it's a crisp $100 bill or it's five $20 bills, the value is the same. And I find that a lot of times clients are seeking a huge find one tax savings vehicle, and that's just not the case. What usually happens is that we can find multiple opportunities to save that will amount to a nice tax savings. And this is the same when you're saving and most things really in life. Don't just look for the one big win. Sometimes it'll take smaller wins to create a large impact. So whenever possible, be open to multiple solutions to get to where you want to be. So now we can get into what you really came for. What can business owners do to minimize their tax liabilities? And for the purposes of the time that we have on today's call, I'm just going to work with the assumption that this is a single member LLC entity. So one person operating in a single member LLC. So my first suggestion to new business owners, and I know you're probably looking at the screen and you're saying, oh, this is not rocket science, but I promise you it's pretty close. Regularly track your business income and expenses. I cannot stress the importance of this enough. I also can't, I wish I could tell you that I don't see it often, but I do. Every tax season, I see upwards of 20 to 40 business owner clients that come in and they gather their income and expenses for the year at my desk, which means they kind of had an idea of how much they made, but they didn't know, right? They know they spent some money, they made some money, but they could not tell you, was March a better month than November, and here's how, and here's how much it was different by. Regularly tracking your business income and expenses is a game changer. It will almost always save you more than it costs you in bookkeeping, however you determine you're going to do your bookkeeping. So avoid rushing to gather expenses only for tax prep. If you're under pressure to gather 12 months of business activity at once, while you're still currently running your business and life is happening, and if it's today, you're also in a pandemic, you will almost always miss out on deductions. And that risk is magnified if you pay for expenses in cash, if you use non-dedicated business accounts, which is common for business owners. Perhaps you used a personal account or you have multiple credit cards. It's very easy to forget that you paid for 2 or 3 things out of your personal account. And just because you pay from your personal account does not mean it's not a valid business expense. It still is. So when you're rushing, you miss things, and that doesn't work well for anybody. So if you regularly kept track of your business income and expenses, all that information would be in one place and you wouldn't miss out on things. This also allows you and your accountant to assist in tax planning and help you with estimated taxes. If we don't know how much you're making during the year, we definitely can't assist you with coming up with accurate estimated tax payments. The next one is to collect W-9s before you pay for any business services. This one is so important. I have seen clients miss out on tens of thousands of dollars of deductions because they were not able to substantiate the money that was paid out to a contractor. So the 60-second lesson on W-9s and 1099s is that this is a business responsibility. You're responsible for reporting to the IRS if you've paid more than $600 in a year to a vendor via cash, check, ACH, Venmo, which, another conversation. But if you've paid it in any method that cannot be tracked by the IRS, it's your responsibility to 1099 that vendor, which lets the IRS know, hey, I paid ABC Company $3,000. When ABC Company files their taxes, the IRS knows to at least see $3,000 of payments in ABC's income. So if you don't collect W-9s before you pay for the services, it is very tough to get it afterwards. If you cannot file the 1099, you run into a position where you may not be able to deduct those expenses, which means they're now your income. So I had a construction client who not substantiate over $50,000 of payment to contractors because they were paid in cash and he did not have any information on them. So he missed out on those deductions. Get a bookkeeping system in place. And it does not need to be fancy. This is not my shameless plug for bookkeeping services. I do not believe every single business at every level of your business needs professional bookkeeping services. I've helped plenty of clients get into a system where they can manage their bookkeeping on their own, right? It can be a spreadsheet. It does not have to be an expensive system. It's just important that you create some sort of system, some sort of routine, some sort of consistency where you can regularly get back to your income and expenses and also your balance sheet. We don't talk a whole lot about balance sheet when it comes to taxes, but it's important to have, be comfortable with your balance sheet as well. But knowing your business performance is so important for estimated tax payments. It's so important for tax planning, but you need a system to make all that work. The next one is to pay your estimated taxes. So if you're not familiar with estimated taxes, if you are solely self-employed or even partially self-employed, that income as a single member LLC, you haven't paid taxes on it, and you don't have an employer that's going to withhold those taxes on your behalf through payroll. So the IRS and the state tax authorities, they don't want to wait until the end of the year and hope you have the money to pay your taxes. Instead, they want you to estimate your tax liability based on your business performance, your net income, and pay that throughout the year. So that when you get to tax filing time, at that point, it's a simple reconciliation. How much have you paid? How much do you owe, or how much do we owe you back? But you're not getting to the end of the year and owe tens of thousands of dollars. You only get a newbie pass the first year. First year you have a tax liability, they don't penalize you. It's kind of like lesson learned. After that, if you generate additional tax liabilities, you will pay penalties for that. And you'll pay penalties whether you avoided it altogether or you paid some, but you did not pay enough. So it's important to get on track so you can pay those estimated taxes. And then the last one, this is not a typo, stay on ready. I consider ready to be your status. Always be at a position where you can go and you know your numbers. And we saw the impact this had because of the COVID fallout and the loans and the grants that were available. And so many businesses, especially business of color, could not get financial records in order in time to apply for these grants and these loans, or you didn't have payroll because everybody was paid as a contractor. So it made you ineligible for some of these programs. So it's so important to have this stuff in order so that if these things come up, and we hope, this is the only pandemic we have to live through, but in the event that these things come up, you're always on ready and you're always prepared to act and act fast. All right, so here's a little test to find out if you are likely overpaying in taxes. If you can't determine how your business performed month over month in less than 10 minutes, right? If you can't quickly pull up a report and say, here's how I did in May, here's how I did in November. If you determine the success of your business by how much money you have in your bank account. I have a client who has a $100,000 net loss, and they currently have about 60 grand in their bank account. So if you only looked at the bank account, you think this business is doing pretty well, but it's not, right? A lot of that money is owner invested money. So you really want to know how your business is doing. You don't want to just rely on the money in your bank account. If you do not make estimated taxes for a business that has net income. So if your business is operating at a loss, and let's assume that that's your only income source, you don't owe taxes. You can't pay taxes on nothing. But if your business is generating a profit and you're not paying estimated taxes, you're likely overpaying because you're generally generating penalties. If you gather your receipts at your accountant's office at your tax appointment, you're likely overpaying in taxes because you're missing out on things. And then lastly, if you pay your contractors or vendors without first collecting a W-9, you could be overpaying in taxes because you could potentially miss out on those deductions if you cannot substantiate what you paid them. So then the second strategy, and again, you may be thinking this is not rocket science, but hear me out. It's a good one. So if you have a business where you get in your car for anything, for networking events, for trips to the post office, to pick up documents from a client, track your mileage, track your tolls, throw parking in there, and your home office expenses, even if you don't think it'll add up too much. So here's the thing about mileage. You will always need to know the miles that you drove to take the mileage deduction, whether or not you take the actual expense deduction or you take the standard mileage deduction. We need to know how many miles you drove in total, and also for business to determine the business use percentage of the vehicle. So if you're using your personal vehicle, it's not a company-owned vehicle, it's not 100% for business. We need that ratio. And if you haven't tracked your mileage, we don't have that ratio, you're going to end up estimating. And my thought process, again, stay on ready. If you ever got audited, you shouldn't be nervous because you should have support for your deductions. So when you track your actual expenses and also your mileage, you make your accountant's job easier to help you figure out which method will create a larger deduction for you. So here's why I say to track it regardless. The mileage deduction for 2019 was worth 58 cents per mile. If you only drove 140 miles every month, that would have created a $1,000 deduction that you could have missed out. 140 miles is only 35 miles a week, right? On average. That could be 2 trips to Staples and 2 trips to the post office, right? So even though you think it's not a lot, if you don't track it, you don't know, and it's difficult to quantify those small trips and how they add up over the course of the year. So instead of saying, oh, I don't think it's much, if it's anything, track it, and then you can decide from there. Another good tip is to get an oil change on January 1st of every year, because then you'll know your starting and ending mileage for your car for the full year if you have an oil change at the beginning or the end of every year. And you must have a mileage log to take the mileage deduction. And I love the mileage deduction because you don't put out real money, but you get a real deduction. So if you don't track it on a spreadsheet or a mileage app, then you don't have the necessary support to take that deduction. For the home office, very similar. You should track your actual expenses so that it can be compared to the simplified deduction at the end of the year. Just keep in mind that the area must be used regularly and exclusively for business. It can't be your kitchen table. It can't be a desk in your bedroom. It can't be your bed. It has to be a designated area, and you can either take a simplified deduction, which is simply based on the square footage of your office space, and that maxes out at $1,500. Or you can take a portion of the actual expenses for your home, and then you'll still use that square footage to come up with the ratio for how much of that will be deductible. I've had clients come in the office and we have a discussion about home offices, and they say, I don't want to take that deduction because I heard it will trigger an audit. And that's not true. And that comes from a very old thought process when very few people had home offices. But this is a legal and valid business deduction. And if you qualify, you should definitely take it. Just keep in mind that it only works for self-employed business owners. It does not work for employees. Employees cannot deduct the use of a home office. The accountable plan is another nice one. This is for business owners with employees. So as you may know, that 2018 Tax Cut and Job Act eliminated unreimbursed employee expenses. So if you are an employee, meaning you receive a W-2, you could previously deduct things that your employer did not reimburse you for, like uniforms or mileage. That went away. That deduction is no longer available except for like special classes like armed forces. So for other businesses, if you develop an IRS approved accountable plan, the business can reimburse employees for the expenses that they pay for out of pocket, and now that becomes your business expense. But what's nice is that that reimbursement doesn't count as wage income for your business, and it's not wages for your employees. So this one's a win-win, because your employees are going to be reimbursed for what they're spending related to your business. You're able to pay them and get the deduction for that. But because the reimbursement income isn't wages, you're not paying payroll taxes on what you have to reimburse them for. So you've essentially reduced your taxable income because you don't have to, you can take the deduction, but you don't have to create employment or payroll taxes for what you're paying the employees to reimburse them for what they've spent. So this one is good for both the business and your employees. Depreciate with intention. This one, your accountant can typically help you with even after the year has closed out. You don't have to make a decision on depreciation during the year, but it's important to be thinking about it when it comes to tax planning. So if you've made large depreciable purchases, but your business isn't making a whole lot of money yet, it's not perfect, but for most businesses, it probably does not make sense for you to take that full depreciation, to take bonus depreciation or Section 179 deduction. It probably doesn't make sense at that time. But if you need to reduce taxable income in a year that you have made these large purchases, it might be to your advantage to take 100% of that depreciation. And tax planning will lend itself to, does this reduce your tax bracket? Does it make you eligible for some other credits that you may not have qualified for because of your adjusted gross income? There are just a lot of areas for planning here. But we have a client that we saved. We reduced their taxable income by $16,000 by taking bonus depreciation in a year where he really needed to reduce his taxable income. By taking all that depreciation now versus depreciating over 5 years, we were able to reduce his tax liability. And then this last one, start saving for retirement. This one is, I don't believe this is like 100% in the CPA ballpark, but it's a conversation that we do end up having with clients a lot. And I'm sure as a financial advisor, this is a very popular conversation. But this is big for new business owners, because if you come from corporate America or any other job, you might be used to them saving for or helping you save for your retirement. You've already set up the 401k. You just have to make a few elections. You have to do that work on your own as a business owner. But I believe strongly in investing in yourself and keeping your money in your pocket whenever possible. So by saving for retirement each year, it helps you better focus on your business. And as a business owner and as someone who speaks to business owners all the time, it's nice to know that there's an end game and that you won't have to work forever. Like I mentioned, I like to spend less so I can work less. So it's nice to know that I won't have to work forever by saving each year for retirement. And a SEP IRA allows you to contribute up to 25% of your net income to a max of $56,000 if you're under 50 years old. But why I like this option is because if you haven't necessarily thought about it during the year, which is ideal, but if you have until the tax filing deadline, which this year is July 15th, to contribute, and it'll count for 2019. So if you have extra cash and it has the potential to perhaps lower your tax bracket, and it will reduce your tax liability, not dollar for dollar, but it will reduce it. This one's a win-win. You're going to save some on taxes, but you'll also be putting some money aside for yourself. We planned this out really well for a client this year, and along with some other things, which we'll talk about on the other slide, we delayed some invoices because he had more income than he really needed. So we pushed some invoices and didn't send them until 2020 to reduce his taxable income. We prepaid some expenses, and then we worked the SEP contribution that he would make. We worked that out to just enough to drop his tax bracket from 22% to 12%. So this saved him a few $1,000s in tax liabilities. And then some other bonus savings, which again, for purposes of the sticking to the time, I did want to make sure that you have this information, but we can't go into a whole lot of detail. But these are some of my other favorite ways to save taxes. Tax planning. Make an appointment with an accountant and just see what can be done. You never know until you have a conversation about your business, where you are, your industry, and your family structure, and how that can all play together to save and prepare you for your tax liability. Your cash basis taxpayer, like the client I mentioned, most business owners are. You can choose if you get towards the end of the year and you're like, my tax bill is going to be a little high. I don't really need any more taxable income for this year. You can choose not to send the invoices because it's not income until you've been paid. And if the client doesn't have the invoice, they can't pay you. Or you can prepay some expenses if you need to lower your taxable income. Now, again, you want to have a conversation with an accountant because this all goes into tax planning, and what you push into next year or what you don't pay next year will affect next year's income. Don't forget about the fairly new QBI deduction. I just amended a client's taxes for 2018. They did their own taxes. They didn't take the QBI deduction because they didn't understand it and they weren't sure if they qualified. So she felt safer just not taking it. And when we redid it, she actually received a refund of $3,000 just by electing to take a deduction that she was eligible to take. Employ your friends and family that legitimately help with your business, and either you just don't pay them or you pay them randomly by sending them Cash App or Venmo, or just giving them money. If they are legitimately working in the business, put them on payroll, make them an employee, and pay them, and then allow them to do what they want with money. That had a client, and an ex-client now for some of these reasons, but I had a client who paid a family member almost $40,000 in just cash, right? Just withdrawals from the bank, not as a contractor, did not want to 1099 them. The person did do work in the business, but they didn't want to put them on payroll. So that was $40,000 that went out of the business that can't count as a business deduction because it wasn't paid as a contractor if it were a contractor relationship or an employee by putting them on payroll. So just think that through. If your children are working age and you can have them do some work in the office, pay them. Don't put your newborn or your unborn child on payroll. They can't actually work. But if your child is of working age and they were going to get a summer job anyway, and you can afford to, keeps the money in your household, but it also lowers your taxable income. And then the last one is restructuring your business when the fit is right. So instead of starting as an S Corp from day one, evaluate with your accountant when the right time would be to perhaps elect S Corp taxation. The point is to make sure that what you're going to spend as an S Corp will be less than what you will save in self-employment taxes once you've elected that S Corp taxation status. So there's a whole lot there, and I'm happy to answer any questions. I don't want you to miss it, but I also don't want you to be here all night. So that brings us to the end. Does anyone have any questions?
Looks like we have a quiet group.
No problem. That is a lot. It is exciting for me, but heavy for others. And I can assure you that in business, I'm a handholder, and I'm not into talking to business owners as if they're accountants. I understand you're not an accountant, so I repeat things often. I talk in layman's terms, but I understand it's a lot.
I know. I think that's the biggest thing about finance. Everything just has to come in stages. But this was wonderful information. I know that even, myself as a business owner, I was just, engulfed in just really listening and picking up a lot of things that, I didn't know. As finance professionals, we don't know everything, especially when things are a little bit outside of our, scope. We're not all tax experts and we're not all accounting experts, even though financial professional kind of encompasses a lot of that. So thank you so much for sharing the information with us, and please let people know how they can get in touch with you.
Yes, so feel free to fill out the contact form on our website. The website is ASE Group offices.com. You can also send a direct email to info@asegroup.offices.com.
Awesome. And you can also find Al-Nesha and other wonderful financial professionals on CHIP. So we look forward to seeing you again and talking with you soon. So everyone take care, continue to stay safe, and have a wonderful day.
Yes, thank you.
Thank you.